Ma'am, we can start the recording.
Yes, yes, it is already started. Dear friends, welcome back to the first session of the day, Master Class in Technical Analysis with Dr. Suyog Savant. As I have already mentioned in my opening remarks, in this 3-day workshop, you will be playing a T20 cricket match. And day 2, that is tomorrow, you will be using one of the most important tool, which is technical analysis. There is a quote by one of the famous technical analyst, Fred Macklin, who has also written and authored a book, Trading the Trend. And the quote goes like this: you don't make money by trading, you make it by just sitting. It takes patience to wait for the trade to develop, for the opportunity to present itself. Let the market come to you instead of you chasing the market. Chart patterns are very accurate, and they have proven their accuracy and predictability over a period of time again and again. And if I may add so, charts really are the footprints of money. A vital part of the trader's success, especially those who trade frequently, is the ability to evaluate the patterns in the trading data. Technical analysis is a technique that can remove the emotions from this trading decision. And a technical analysis can generate the buy and sell indicators and help the trader locate the new trading opportunities. With the improvement in the software and the speed of accessing the millions of data points, you can really make a killing in the market. Today, it is a privilege to introduce one such wizard in technical analysis who has mastered the art of technical analysis within a couple of years and is really minting money. We have with us Dr. Suyog Savant, who will be taking this session on technical analysis and sharing some of the tools which he is using. Dr. Suyog Savant is a master of dental surgery in public health dentistry from the D.Y. Patil Dental College, Pune. And he is having a roaring practice for over a decade. He is also in academics and is currently working with Bharati Vidyapeeth Dental College and Hospital Navi Mumbai since 1st April 2015 as an associate professor and an HOD. Dr. Suyog has conducted more than 300 plus health education and health promotion camps in schools, colleges, municipal hospitals, and orphanages and NGOs. Dr. Suyog has conducted over 100 preventive and restorative programs under the school dental program and over 50 health education and health promotion camps in schools. Dr. Suyog had a passion for the stock market and he started learning technical analysis and is now sharing his insights with you. So put your hands together for the master class on technical analysis with Dr. Suyog Savant. So Dr. Suyog, the virtual stage is all yours.
Thank you so much for a wonderful introduction, ma'am. Today, I'll be sharing you the technical analysis of stock markets. Well, market to sabka hai boss. That's what they all say, you see. And during the COVID times and the pandemic times, you really had nothing to do but to learn new things. And one of the friend was trying to introduce me to the stock market since a long period of time, but because of the lack of time and all those kind of things, I didn't get through. But then I watched a few series on stock market, some movies, and I was quite fascinated with it. I mean, which job or profession introduces you to mint money or make money at the click of a button? But definitely, without knowledge, it's a really risky game. So before I start with the technical analysis, I would like to tell you there are two arms of stock market. First one is the fundamental analysis, which gives you the know-how of a company, whether the share is good, whether it comes from a good company, whether the company is growing, it's progressive, whether the returns are good of the company, has it expanded exponentially. As Reliance, you can say the share price was introduced at around 85 rupees or something or so, and it went on till 2600 rupees. Why? Because the company grew and the stock grew. But what is more important to know, that when should we take up a trade? Like, when are we supposed to take up a trade? Whether the entry point of the stock is good, fine, we might get a good trade. But in case if the entry point is really bad, then you are going to go for losses. And you should also know when to cut down your losses. That is about risk management. So I'll be talking about the technical analysis part, in which you will be understanding how the stock market works, how the charts are seen, and with the help of the charts, how you take entry and exit into the stock market. Can you see the screen by any chance? Am I
Yes, yes,
everything?
yes, yes,
All right,
yes.
all right. Okay, to start with the basic of technical analysis, I'm keeping it very simple, because in stock market only one rule follows. Keep it very simplified. Look at the charts and take up the trade. In case if you're going for a loss, you hit the stop loss, you cut the trade. And in case if you're getting the profits, keep trailing the profits till you know when to exit. So first, content in the contents part, I'll be talking about the candlesticks. What are candlesticks? I'll be talking about it. Advanced bearish candle, bullish candle. What are they? Candlestick patterns, the breakouts, and technical indicators. Technical indicators are some indicators which basically give you an option to buy or to sell. All right, what is the momentum of the stock going on? How many people are buying it? What is the volume? Is it a dull stock which has not moved over a period of time, or is it gonna shoot up, or is it gonna come down? So all these things I'll be explaining it to you in the technical analysis part. Stock, two candles. Now, what are these candles? Bullish candle, bearish candle. It's very simple. Previously, when you used to see the graphs in schools, the graph used to go up or used to go down, right? It was very simple to see, like the line chart diagrams, pie chart diagrams, or frequency tables or histograms in stock markets. This is the most commonly used pattern. Now, what does this indicate? Bullish candle, it's green in color, and the other one is the bearish candle, it's red in color. So when you talk about the bullish candle pattern, it means a stock opens at a certain price, at this price, say where it's written as open. Over the period of day, it goes up, 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 and then it hits a high. High is the highest point where it has gone. The stock has really shoot up. But however, does it always happen that the stock that shoots up stays at the same level? Yes, it might happen. But at the end of the day, it has to come down and close. As you can see the cursor here, and it closes over here. So basically what I intend to tell you, this is a basic candle which shows that the stock market has gone up. So it opened at 9:15 a.m. in the morning here. Let's assume that it went up, it went to its highest point, and then it retraced back and closed here. Now you might say, okay, fine, then what is this low? Now this high and this low, the lines that you see are called as the wicks of the candle. A candle normally has one wick, right? So here this candle has got two wicks. And what do the wicks represent? The wicks represent, it's the high and it's the low of the candle, which means this candle, it might have opened here, somewhere about here. It went down, down till it hit the low, and again it came back to its highest point, and at the end of the day it closed here. So this is called as the bullish candle. Now let's talk about the bearish candle. How does the bearish candle work? It works exactly in the opposite direction. It opens up high, or it opens up at this position, then it moves high, goes up, and suddenly when the selling takes place, the stock falls down, falls down, falls down, and it might come to its low here. And again, it retraces back to its closing point at the end of the day. So basically, it opened up high and it closed the candle down here at the close part. So it means that the stock has fallen and it has given a red candle. So basically, green candle always indicates that the trade is bullish in nature or people are buying the trade, and red candle indicates that the trade is bearish in nature and people have sold off the stock. Now this is just a basic pattern, but can you decide a trade to take with the help of single candles? No, you cannot, right? So there are some types of candles which I'll be showing you later. Now look at this candle. It's another type of candle. In this candle, what has happened? It's a hammerstick candle. What does a hammerstick candle mean? It means that the buyers are not totally in control. The people have sold the stocks and the buyers took positions, and the stock has risen. As the stock goes up, goes up, goes up, goes up, it hits a high, it forms a hammerstick. It means it's partially in control of the trade. It means that this stock is quite weak, and or the stock is ready to shoot up from here, which means that people were not in control and suddenly the buying took place from here, and the entire red candle came up to this point where it opened and then went up high, close at the highest level for the day, which means the trade might be able to shoot up. I'll be showing you all this kind of candles on the charts later on once I explain the candlestick patterns. All right. So in this part, it's the very same part, but it's the opposite one. However, this is also considered as a bullish candle because it has a because people might have tried to sell this trade. Okay, it was a red candle. Yes, you can see the red candle. However, it's not the entire red candle. It's partial red candle where it opened up here and it went down a bit and closed here. Look at this part. It did not, it might have just fallen, went to its lower end, but however, the buyers were again in control and the candle closed at a point where it is not far away from the open scene. So this is also called these two candles are called as the hammerstick candles, and hammerstick candles sometimes or many times are kind of breakout candles which they show in one of the pattern called as the Morningstar pattern. Now this is a bullish inverted bullish hammer. It means that the candle, the stock price went high and it came down to its low point. It closed here, but however, it did not turn green. On the other hand, look at this candle. It was the red candle. It must have gone high and again went down. But here the buyers are not in control. It means that the stock might have opened somewhere around here and closed around here. In this case, the stock might have opened up here and gone up here and closed down. So basically, it's an inverted bullish hammer pattern, and it indicates that the next trade the stock might just go up. While in the case of a shooting star, it has to go down in this case. What do you mean by a pin bar story? It's very simple. It is a depiction of a hammer type of candle which closes down to this indecisive candle, which means just do not, I might be reading out some of the things. You do not have to concentrate much about on the reading, but see to it that you more concentrate on the graphical patterns that represent. You might be seeing, we are seeing so many candles. How are we going to recognize it? It's very easy. It just needs, you need to take a look at the picture. It's the same manner in which you see a song. You don't go into the specificities of the song or a movie, right? You see something and you just know it, that it's that kind of a movie which I have already seen it. So in this part also, you just look at the candles and do not concentrate on the reading part. I'll do it for you. So basically, the measuring the strength of a bullish and the bearish candlestick depends on how the candlestick closes. The stronger the closure, the stronger is the confirmation. It means, look at this. It's a strong candle. It's just the representation of a hammer candle. It must have opened up somewhere about here, gone down and again went up and closed here, which means it's ready to take off from this part. This is the stronger because this was the strongest because it doesn't have a wick, it doesn't have a high. Okay, it closed at the higher level. In this case, this candle in this, it's a strong candle, but however it has gone high and just retraced a bit. So word of today is retracement. Okay, now let's go on for the third candle. Even this candle is a strong candle, yes, but it has shown wicks on both ends. However, the smaller the wick on the upper end, which indicates it's still bullish in nature. On the other hand, look at this. This indecisive candle is called as a spindle candle, which means the trade has moved both the ways. It has opened here, went up, retraced back, again went down, and again came back to its closing. But however, whatever you see here, the closing and the opening of this stock is very close to each other, and it has formed very long wicks. What does long wicks indicate? It's an indecisive candle, but the buyers are slightly in control, so we do not take up a trade at this level. It can be a risky one. Let's talk about the bearish patterns. Look at this. It's an inverted hammer. It doesn't have a wick on its lower end, and this trade is going to go down, so it is the strongest of the part. In the same manner, as we continue, this hammer has got a smaller wick, which means a larger wick at a upper end, which means that this trade is bearish in nature and it is going to go down. Okay, this candle again, as the wick goes on increasing on its trending side, it means that this candle is becoming weaker and weaker, and this part is called as an indecisive candle. Again the same, but however in this case it's bearish in nature, and the sellers are just in control of the stock. Again the same pattern. Look at the sticks. As you can see, the bullish candle, the first one in this picture is the bullish candle, and the second one is in the picture is the bearish one. Now, why these two candles are considered the strongest at the bull's end or in the bear's end? Only because they don't have a wick. Look at this. It doesn't have a wick. It must have opened here. It did not go down. It just went on going up, and closed without a wick. This type of candle is also known as a Marabout type of candle. All right, same is the case with this bearish candle. Look at this. It formed a wick down. It formed a wick on both ends. The candle is becoming weaker and weaker and weaker. Look at this. The candle is still in bullish in nature, and this part is called as the inverted pin type. And in this part, it went all the way up. However, the sellers took control, not to the point of it turning it red, but still the opening and the closing of the candle is very close to each other, which means it might just start forming the bearish pattern. All right, in this bearish form, again the same thing. This candle is, first one is a very strong bearish candle, and the next, as and when it decreases and it comes to the last point here, the trade has gone down, dipped to its lower end, and again closed back near the open end. But however, this is turning out to be a hammer type of candle, the first candle which we saw, and this one turned out, the first one, the one in the bullish setup, turned out to be an inverted hammer. So to summarize, buyers' power can be explained. Buyers are in total control. Buyers are in still control in the second candle as one wick is formed. Sellers showed down, but buyers are still in control of the candle. Sellers are getting stronger and stronger at the fourth candle, but the buyers are still in control. It's still a green type of candle. Sellers are active and they have started to take control of the stock, but the buyers are just little stronger at this end. As you can see, a big wick formation. Finally here in this last part, sellers are more stronger, buyers are so weak that it's going to turn red. Again the same psychology. Buyer in the first candle, buyers have the total control. Second one, buyers are in control. Third one, sellers are gaining control, and the fourth one, buyers are losing power. Now I have explained you the candles. What about the patterns? How do you decide when to take a trade? Okay, so this part explains you a pattern formation of 3 candle formation or 4 candle formation, which will help you to take up a trade. Now this bullish candle, look at this first one. This is a Marabout. It doesn't have a wick. It just formed a wick here at the lower end, but however the entire body is in green. So basically it is called as a 3 soldiers pattern, and it means that the candle has started to rise. Okay, which means the stock has started to gain. It is going to go up and it's trending in the upward direction. Look at this pattern. It's called as a Morningstar pattern. This patterns are very famous when it comes to trading. I personally love this type of pattern, Morningstar, and the Evening Star pattern. Evening Star, it's given in the later part, but Morningstar is the best part because it gives you an indication when to take up a trade. Look at this. A red candle has formed. The trade went down. However, the buyers came in control. It formed a green candle, and another green candle was confirmation. So from here, for scalping purposes, I take up this trade for 5 minutes or 10 minutes straight, and that's more than enough for me. in case if I have to scalp. Look at this candle, Marubozu. It doesn't have a wick, which I spoke about, which means it's a total bullish candle. The buyers are totally in control. Dragonfly doji. Now this type of candle is something like a pin bar, which forms in which it opened and closed at the same time. However, in this it can be called as a bullish candle because it went all the way down. The buyers took control, got it up, and it ended in green. Inverted hammer. Again the same part. I won't go again with it. Look at this bullish engulfing candle. This bullish engulfing candle is something I'll be talking later on, which means the entire green candle has engulfed the red candle with the opening and the closing of this candle above and below the red candle. Morning doji star. Look at this, a fantastic pattern in which the buyers came in control and the next candle gave the confirmation. And bullish piercing, this bullish piercing pattern, it means that the stock opened below its low and closed above the previous close, and then it must have started to rise. Okay, look at these confirmations. Rising tree method, which means that it formed a green, two Marubozu candles are formed in between three red candles form, and it gives an indication called as the buy. Look at this gravestone doji. As I was talking, it can be called as an inverted hammer as well, in case if the body of the candle was quite big enough. In this formation, the sellers are just taking control and it has given a signal. This rising three method and falling three method, you do not need to remember the names. Try to focus on the picture. These kind of pictures should be embedded in your brain when you take up the trades. Oh yeah, look, this pattern seems similar. I should sell the trade because it has formed some sort of a pattern which I can see it's bearish in nature. I don't need to remember the names for it. That's what I do. Exhaustion impulse. What does exhaustion and impulsion do? Look at this. Why it has given a buy? It has not formed any pattern. It has given a buy only for the reason. Look at this dotted line. This one is acting as a support. The candles are trying to break this support, break it. No, it doesn't go down. No, it doesn't go down. It has not broken the white line. And from here, it has given a shoot up. Of course, this will be a confirmatory candle, which means I'll take a trade. Sell signal. Look at this bearish fake out. Bearish fake out on a 5-minute candle chart. It's very simple. This, as you see here in this bearish fake out, the white dots represent the resistance of the candle. It means the candles are trying to break out this and go up, but it's not possible for them. So once the green candle is formed here, I'll necessarily wait at least 5 to 10 minutes for this trade to go up beyond this support line. How do you form the support lines? I'll explain it to you later. But for this trade, you need to understand, please do not be impulsive during this time. Once you got a green signal, you go on till this. If you find a red candle, look at this. It formed a red. It formed a green candle. Then here, then it formed a red, and a confirmatory candle was a red one. It's like a evening star pattern where the trade begins to come down. Similarly, look at this exhaustion and impulse. For the sell signal, it is exactly the opposite of this buy signal. Here, the three candles took support from the white line and then it shot up, that is from the support line. Here, these three candles took rejection from this line, that is the resistance line, and the candle went down, and that was the confirmatory red signal. Again, dragon doji bullish pattern. That's again the pinhead bar candle you can see, and this is a spinning top. Spinning top is something indecisive candle when the wicks are visible on both sides, and the body of the wick here and here is equal to the body of the entire candle. So it means it's very indecisive candle, and the trade can go either ways, and mostly on the bullish side because it is representing a red sign. Like it must have opened here and closed here. So these are the patterns. It's the same patterns that you can see. You are supposed to remember the pictures and not the names, just for the purpose of studying. And you can use it for the trading part. For scalping, yes, it is really useful. Look at this evening star, which is formed in here. It's beautiful. It forms almost a Marubozu candle. It forms a cross, and again the same size of a red candle. From here, I'll be taking a negative trade. From here, I'll be going in for a negative trade. All right. Look at this bearish meeting lines, three black crows, three candles in a row. They're called as the three black crows. Three candles in succession on the buying side. It is called as the three moving soldiers pattern. This is the same thing as I explained you Morningstar. Concentrate on the chart. I'll be reading things to you. The Morningstar candlestick pattern consists of three candlesticks. The real body of the second candle develops in the lower shadow of the first candle. Look at this. The real body of the second candle and the real body of the third candle does not touch the real body of the second candle. That is this one, which means it when the stock is coming down, 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 down. Here it takes a support and a green candle is formed. And look at this pattern, beautiful pattern that is formed, which is called that after the closing of this candle, I'll be going in for a bullish trade. Now the patterns of the Morningstar. Look at this weak pattern here because this candle it has formed a small wick. This is a standard pattern. Here on the upper side, no wick has been formed. And this is the strongest of all because you see hardly any wicks are formed. It's a Maravizu candle, which means the trade is really going to be a strong one to take. Which one will you represent? Yes, this one again is a Morningstar, but a big wick. So it is basically a weak Morningstar candle that is formed. A candle which doesn't have wicks are supposed to be called as the strongest of the candles, and stronger the wicks, the smaller the wicks, the stronger is the trade. Evening star. Look at this spindle shaped pattern that is formed at the upper end. The candles kept on going up. The first candlestick is tall green colored candle. The second candlestick's real body develops in the upper shadow of the first candle. The third candle is the long bearish red candle with the wicks, which means that it's gonna go down. The trade is gonna go down. This is an evening doji star candle. This is called, I can also call it as a spindle shaped, somewhat in nature, which is indecisive. And this red candle is gonna give the confirmation that the trade is gonna go down. Three black crows, last attempts of the bulls, which means they are showing lower highs, which means the trade is gonna go down, and lower lows. Look at this, lower lows, lower lows, lower lows. Here, lower highs, lower highs, lower highs. It means three black crows. It means that the trade is gonna go down. I'll show you on the Nifty chart exactly how it looks. Three white soldiers, again, three candles in a row. They are making higher highs and higher lows. It's gonna go up. This is something that is the lower highs and lower lows. Bullish Haramika pattern. Now this is a candle which is an inside candle which is formed, which gives a representation that this small candle is engulfing the entire red candle, which means that it's small in nature. It doesn't have any wick. Do you see any wicks here? No, it doesn't. Except for the fact that it's entirely in green in nature, which means buyers have come into play and sellers have disappeared, which means this candle is gonna eat up this red candle. That's what it is called. That's the reason it's called as a bullish one. And from here it's a confirmatory candle as well, and from here it can just rise up, so it's called as a bullish Harami pattern. Again, this one is a bearish one. The bearish body should be no longer than 25% of the size of the entire bullish candle. So this red candle that you see here is something that is formed and it is going to engulf the green candle. That's what it means. The red candle drops down from the close of the previous candle to open lower. So this is called as the bearish candle, and this candle is going to go down from here. The next trade will be going down. It has engulfed the green candle. So this is again the bullish engulfing candle in which the candle tries to eat up the candle here. The bullish engulfing candlestick pattern does not have to engulf the preceding candlesticks, upper and lower shadows, but if it does, like it has been illustrated, the bullish engulfing candlestick is even more bullish, which means here that this candle has tried to go down. However, the requirement is that this candle is going in a downward pattern and it's going to engulf the previous candle. So this is called as a bullish engulfing. Again, the bearish engulfing pattern, it's one and the same thing. Look at the red candle. The entire red candle has eaten up the previous green candle, and opening and the closing of the candle lies within the boundaries of the red candle. So after this trade, it's quite obvious that the stick or that the trade is going to go down. Move on to the bearish engulfing. It's the same thing. Look at the strong. Now I'll be moving to the strong signs of reversals. We have spoken about it, and it's just a representation in one chart which I try to take it, in which how the patterns have made form. Look at this. This is a bullish engulfing candle. The entire candle has engulfed the red candle. Morningstar pattern, again the same which I explained you before. Look at these three candles. Hammer shaped candle. Look at this. The trade went down. Here you can see a spindle shaped top formation. This is a hammer. It must have gone down and the buyers came and took control, and from here the trade went up. Similar with this part, the trend was rising, a red candle formed, a bearish engulfing pattern formed here, and the entire candle engulfed the green candle and the trade started moving down. Again here the evening star, it's the opposite of the morning star which is seen on the left. A spindle shape formation, green candle is formed at the top. From here the trade reversed and the trade went down. And shooting star, shooting star is something, look at this, this is a shooting star or an inverted hammer that you can call. Here the trade green candle formed, however the sellers came in control, and look at this, it seems like a falling hammer, right? So it is also known as a shooting star pattern, and from here the trade went down. So these are the same types of candles. You do not have to read this except for the fact, just look at the figures, how the trades have taken up with the arrows, bullish doji formation or the spindle formation you can say, and from here the trade shoot up. Tweezer bottom or the inverted hammer, from here the trade went down. Tweezer bottom here, it from here the trade went up, or it can be also be called as a hammer pattern. Bearish doji or the spindle shape with the red color, which means the trade went down. See, the difference between the bearish doji and spindle is very simple. The opening and closing of the candle now is very close to each other, which forms as a spindle shape. Look at this. This is a spindle part. The opening and closing are really placed very close to each other in this Morningstar pattern. So this is a spindle shape. However, as the body goes on increasing, it is called as a doji part, doji candle. Okay. So this is dragonfly. It is a smaller representation of a hammer part or a green pin bar part. Here, even in the dragonfly doji, look at this. The opening and closing are very close to each other. Now, when a candle forms bullish Marabuzu, again I'm explaining you this. This is a very strong candle. It doesn't have the wicks. From here, the trade has to go up. And on the right side, this is a red part. Here they do not have the wicks, and from here the trade is strongly going to go down. That's what it indicates. Okay, now I spoke everything about the candlesticks and its patterns, how 3 candles or 4 candles form a trade. I shall be moving on to some other part called as the moving average. Now, what do you mean by a moving average? Look at this candles. All right. You can see this, see it on the screen, right? Golden crossover. What is this 550 MA, 200 MA? What is it that cross? It's very simple. Every stock moves in a certain range. Sometimes it's high, it is low. All right. But if I want to know whether the stock has been good enough, I'll try to see what is the price of the stock in this in 50 days, 10 days, 200 days moving averages. Like I might say, listen, you know what, in 50 days moving average, the stock is moving at the same place. Then you might say, oh, so 50 days moving average, it has stayed the same. Yes, but as the moving average has increased, has the stock gone up? Yes, it has gone up. So people have the habit of taking up a trade with the help of 50 days moving average in a short-term trade. For long-term investors, people have the habit of looking at 200 moving averages. All right. And when does this and what do you mean by death crossover? It means 50 moving average is below the 200 moving average, which means the stock has suddenly retraced back and started falling. If it goes below the 50 moving average, fine, we can understand. Okay, there is a certain retracement. But in 200 moving days averages, if the stock falls completely, it goes below the 200 moving average, it means that the bearish trend has started. Now on the Nifty charts from May, I think around 2020, I'll explain it to you. The Nifty chart has always taken support at about 50 moving average part. However, when it came till 18,600 Nifty chart, it crossed that 15 moving average, and now it is trading below the 200 moving average. It has just fallen yesterday below the 200 moving average, which indicates that Nifty has come into the red zone, which is the the companies of the Nifty market are going to fall, and they have fallen to a bit. So the retracement has really occurred, and Nifty chart has always taken support on this line, on 50 moving average part. All right. So this is what it means. The 50 moving averages. It means that the stocks take support on a line called 50 moving average, which means that the stock is maintaining its rally. When once it starts falling below 50 moving average, yes, it is turning bearish, but it's just a small retracement. That's how I see it. 200 moving average, when it touches it, it is really a concerning matter, and death cross is something that these two averages cross and the stocks fall below these two lines. So it is really called as a death cross, which means we are going into some kind of recession phase for the Nifty stocks. Look at this. 4 ways you can use the moving average pattern. It means the stock comes up, goes down, takes a support at this level, and again goes up. As far as this blue line keeps on going up in this pattern, it means that yes, the stock is moving up. Look at this short term, the second part, the short term moving average crosses the long term. Now this thing, when it crosses the long term, it means that it's a crossover and the trend reversal is gonna happen. So this is what it means. Sometimes, as I said before, the Nifty takes supports at these levels, at the 50 MA crossovers, they take support and bounce back. Again, they come down, take a support here and bounce back. So this is called as a support and resistance. Price crossover, again here, look at this. This part, it has crossed the 50 moving, this candle, first candle in the fourth part, it has crossed the 15 moving average, which means it's a bullish Marabazu candle, if you can see, and then the stock is always going to go up. We shouldn't be concerned as long as the stock price stays above 50 EMA. So that's what it means. Once it touches and starts falling below, we should keep the stock in the radar to see whether it's coming down or what. Sometimes moving averages, they have the habit of taking the resistance at 200 EMA, which means it is, look at this. So what are support and resistances? I'll tell you on the charts. It's easier to explain. I won't go into the reading part into it. Look at this. The stock went up, 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 up. It hit the 200 EMA and it faced a rejection. Now look at this candle formation. Green, green, up. It took resistance. And look at this candle, a red candle. Now this candle can also be called as a bearish engulfing candle. This pattern can somewhat be called as a strongest evening star pattern, and from here the downside started here. All right. So this is what this is the candlestick pattern I was talking to you about. Now again, as coming back to 200 EMAs, it went down, it must have taken support here, again tried to go up, again faced resistance here at 200 EMA, and again it went down. So it means it is taking resistance at 200 EMA and it's coming down. Again, the third time it went and hit the blue line, that is the 200 moving average line. Now, when a stock hits 3 times or 4 times to its resistance part, it means that the resistance is weakening. Similarly, when it hits the support line down 2 or 3 parts, the support is getting weak. So there is a high probability of a stock to go up. Now here the down arrow has been shown because just to explain you how resistance has been taken at 200 EMA averages. All right. So this is something, it is the potential reversal can be seen, and from here the stock might go down. However, it breaks this, it's gonna go up and it's gonna rally. So basically what I'm trying to teach you is support and resistance. Another one pattern that I can see here is somewhat, I can say, as a W formation pattern here. Now I am just telling you some parts, you need to remember it. W and M type of formation, I'll come to that later on. But look at this. Doesn't it seem like a W pattern? So, and let's assume that this 200 EMA is a neckline of that W shape. So basically what it means, that if it has formed a W shape formation and the stock comes at the neckline here, it is bound to go up. This is the favorite pattern used by most of the investors in the long time investment process. All right, once the breakout happens, it's gonna be a big one. So basically, what I wanted you to explain you is how moving average 200 moving average acts as a resistance part here. All right, let's move on to this a strength of resistance. The same part, the strength of resistance I was explaining it to you. Look at this. 3 times rejections. This was the strongest of one which I showed it to you in the previous slide. These are the smaller type of resistance, and these are the type of evening star pattern. From here the stock goes down. Understand one thing, I'm stressing more on Morningstar and evening star pattern because they are the simplest of the patterns, and our stock market has always fallen very badly from 18,600 using these type of patterns. It has also formed a W shape, M shaped of pattern, which I'll be explaining it to you later on. But these patterns are really important, and they are the easiest of the pattern to understand how to take a trade. Now again, this part, as I was explaining it to you, resistance, support, right? So these are the resistance. The candle went up, it hit one time, again it went up, it had its resistance second time, again here it went up and hit the resistance third time. What did I say before? As the resistance goes on, as the stocks go on hitting the same resistance twice or thrice, it always gives you a breakout pattern, and this is the breakout pattern I was referring to. All right, and this is the support part. It has here, you can say it has made two double bottoms, which means it has come and hit the supports twice. It hit the resistance 3 times. Look at this. It is a W pattern, right? Somewhat like a W pattern. 1, 2, and this is the neckline. It faced the resistance. Once it had a breakout, it went up. Again, the resistance pattern I'm showing it to you. Look at this. It hit the resistance 1, 2, 3, 4, and finally when the breakout happened, it was a real kind of breakout. So the entire stock went up. What do you see here at the bottom? These are the volume candles, which indicates that people are buying or people are selling. Larger the green candles, it means the stock is really going to shoot up. Smaller the red candles, it means that the stock might retrace back a bit. So this is what it means, the resistance, and this is the support part. Now this is somewhat an inverse pattern. Inverse pattern is a M pattern. Look at this, the formation of the M's. Now these are not exactly the formation of small M's are formed, but if you draw a neckline here, the stock has given a false breakout here. Okay, look at this. Again, a simple type of M pattern. I might draw a line here, and the breakout happens here, and the stock entirely comes down. So basically, in this part, 2, 3 times resistance, it has hit the resistance. However, it hit the support 4 times. 1, 2, 3, 4. The support went on becoming weaker and weaker and weaker, and finally it broke, and a downfall could be seen in this part. Another thing that you can see in the part in this slide, 2 parallel lines here. Okay, and the stock kept on moving in this entire part. It is called as a channel pattern, which means the volatility is not much. Now, what is the word volatility? You'll be hearing it for a longer time later on, but volatility means how much the stock moves up and down. In this part, look at this. It's moving in the same channel pattern. It's not going up, it's not coming down. It's not going up, it's not coming down. And it is there in the channel. Once the breakout happens, ideally people wait for this channel pattern to to get over, and either of the trades are taken up in by the traders once the channel pattern breaks out. Okay, now coming up to the next part. What are these? These are the patterns that are ideally identified on the charts for the breakouts. The channel pattern, as I showed you here, it moved in a channel, it went up. Now this is a flag type. Look at this. It's a pole in the first part. It moved in a channel pattern for some time, and then it gave a breakout here. And finally the trade went up. So it is called as the flag pattern. Look at this wedge pattern. What do you mean by wedge pattern? It means that the trade went on, volume went on constricting. The People were not buying or not selling, and the entire volume came to this level. It converged into a triangle, and finally whatever the breakout it took place was from here. Once it went out of the out of this triangle, it had a breakout, and the stock turned bullish. It went up. In either of the case, look at this ascending triangle. The trade moved up, then again slowly it retraced, again it went up, slowly it retraced, and it converged into the end of the triangle, and this is called as the ascending triangle because the trade, once it broke out, it went up. Pennant is something similar to the ascending or the wedge pattern. However, the stock basically doesn't move in the upper or the lower direction. It stays in the same range, and finally it gives a breakout. Okay, now look at this. Why am I avoiding this? No, I'm not avoiding this. This is an inverse head and shoulder pattern. Now this inverse head and shoulder pattern, it's something like a head is formed here, and on both the sides shoulders are formed, which means, and this is the neckline again. So once it breaks up, this neckline is broken, the share markets, the stock market is gonna go up. I'm referring to this chart. Like, look at this. The middle part is the head. Here are the shoulders. Why it is called inverse? Because it's upside down. You will see a real head and inverse pattern. I put up a slide there. It's beautiful, and from there it went down. The Nifty almost collapsed. So, and this is a pattern, inverse head and shoulder pattern is also one of the favorite pattern in which it shows the upper breakout. Now you might say, okay, can we call this a W pattern? No, you cannot call this a W pattern, because look at this. This green candles on both the sides of the heads have closed above the head. All right, so you cannot call it as a W pattern. It doesn't have 2 or 3 bottoms. It has not taken support at the bottom. Okay, so that's not a W pattern. It's an inverse head and shoulder pattern, and this is a cup and handle pattern. Cup and handle pattern, which means that it is a cup and handle. If it would have been inverse cup and handle pattern, it would have meant that the trade will be going down. Now this is a cup and handle pattern, which means the trade came down, went up, hit the resistance part, stayed in this channel for some time, and then gave a breakout, which means a cup and handle pattern was formed. It's the same trading symmetrical triangle. Understand one thing, these trading triangles, no, you don't need to remember so much. If you are able to point out these lines in either of the side where the breakout happens, you need to take a trade. Do not remember it's ascending triangle, descending triangle, pennant pattern. No, try to form these line patterns on the charts and see to it where the breakout takes place. So I'll be explaining you on the charts as well, but these are the types of pattern you need to understand. Look at this symmetrical triangle pattern or the pennant pattern. In this, the trade stayed in these, kept on constricting at till the end of the triangle, and either of the side breakout took place, you took up the trade. All right, so look at this chart. It's a simple pattern. They have joined in this part, they have joined the resistance of this entire Nifty chart. Now this, we found a reversal. It went down, it hit the bottom, it took support, again went up. However, it again went down, again went up. It hit the resistance. So basically, what has happened here? 3 times the resistance have been hit, and 3 times supports have been taken, and we formed a trend line which formed a pennant form of triangle, and either of the side where the stock breaks out, you take up a trade. All right, so this is what it means, the triangles. That's how it works. Again, another example of a trade. Nifty Bank. Okay, it went high in the month of, I think, October or September. I don't remember now. But after that, yeah, November, right, around October. It went down, came down, again hit the resistance. What is this forming? This formation is called lower highs and lower lows. Here, look at this: lower highs, lower highs, lower highs, lower highs, and lows were forming. And from here we took this Nifty chart is basically taken in order to indicate how 30-minute chart, how the patterns have been formed on 30-minute candle. From here, I would have waited for the breakout to happen from here, either upper side or the lower side. What are these lines? These are the resistance and support lines that have been formed. Again, the triangle pattern. Look at this. Beautiful triangle pattern that is formed on the 1 hourly scale. Now this one was on 30-minute scale. Okay, look at this, 30 minutes. All right. So in this case, it's all 1 hour form, or 1 hourly form. Here, look at this triangle. It is going down. It's forming lower highs and lower lows. Triangle has been formed. From here, I would have waited for this breakout to happen and might have taken a small scalp here. On the other hand, if the breakout would have happened here, I would have gone very aggressively towards the lower end. Look at these three tops that have been formed. If now look at this, one resistance form, I can see a triangle forming here. One resistance hit here, another resistance hit here, third one. I would have drawn a line from here and supports. Look at these supports. 1, 2, 3. Another line would have been, I would have drawn here. One triangle, second triangle. I'm just not drawing the line so that you will be identify the patterns. All right. So this is a parallel line that I draw. From here I draw an ascending line. So basically it is an ascending triangle. So here somewhere where the convergence would have taken place. All right. And on either of the side it would have broken up. I would have taken up the side. Now once the convergence formed, it is an ascending triangle, so the trade went up, and you look at that, how till what end it went. Now this part that you can see, it's a channel pattern. It has stuck into this pattern, somewhat like this. And once the breakout took place, again I would have taken a trade here. Again it hit a resistance, I would have stopped, not taken a trade. No trade was available here because there were no resistance at that time. All right. So this is how it works. Again the same part. Look at this. As I was explaining you the previous chart. Here on 30 minutes, because the convergence took place, it hit the resistance here 1, 2, it took support 3 times. It took support 3 times, and either side the trade would have been broken up, and I would have taken the trade. These are the rare chart patterns. It's the bullish cup and handle pattern, bullish diamond form, bullish scallop. They don't mostly occur on the chart, but yes, I've been seeing a lot of bullish cup and handle pattern recently. All right. So this is a bullish cup and handle pattern. Do I see it here? No, I don't. Anyways, so look at this again, the same font. Why am I showing you again the same pictures again and again? So that it stays in your mind, that you have seen this. You'll be able to identify it. The using theory, knowing theory, fundamentals, yes, it is needed to select a company. But when you actually want to enter the trade, you really need to know what kind of pattern happens and how you need to enter. And on every chart here, stop loss is being seen. Why stop loss is seen here? Look at this here, entry and target points. Only for the reason markets are not going to follow you. You are supposed to follow the markets. If the market moves against you, you have to cut your trade here, or else you will go in for massive losses. So basically, do not be greedy. In case you are facing losses, you need to cut down the stop loss, and the stop loss will be something like 1:1. That is, you go for 1% of profit, you go for 1% of loss. Or if you want to go for aggressive profits, go to the ratio of 1:2 or 1:3. Do not expect the market to give you 20 times returns and 100 times returns in one single trade. No, one single trade you take, you put in a stop loss, and then you go for profits. In stock markets, 3 things are more important. First is to cut down your losses. Second is to save your capital, and third priority should be make profits. We all enter stock markets to gain money. I understand that has to be the priority, but it's not always that happens that way. So first thing, cut down your losses. Get into the market that is saying that no, I'm not going to make a loss more than 500. Second thing, I'm going to save my capital of 10,000. And third thing, it should be then I'll be making the profits. Okay, if you move with this principle, you will be able to cut down your losses and you will be making profits. Now coming back to the lecture again, look at this falling wedge. I explained you symmetrical convergence triangle. I explained you cup and handle pattern. I explained you where 3 times resistance was been hit and the breakout pattern took place. Inverse head and shoulder pattern, in which 3 times resistance was hit and the breakout took place. Again, the convergence triangle pattern, ascending triangle pattern, which I showed. Look at this. Look at this pattern. This is the same part which I explained you here. Yes, this one, convergence pattern. Look, 1 line, 2 line, and the trade took place in the upper direction. You understand? That's how it works. So this is the way it is. This is bullish rectangle pattern. It means it moved in the same range, and where the breakout took place, the trade went up. This is something like a continuation and the reversal pattern. Look at this, the W pattern. 1, 2, it broke the neckline, the trade went up. This is the inverted W pattern, that is the reversal pattern. It hit the resistance twice up, 3 times support was broken, it went down. It's a M pattern. Again, when the neckline of the M pattern was broken, the trade went down. Ascending triangle, descending triangle, I explained it to you. Bullish wedge, it moves in a channel, upper and the lower direction. Wherever the breakout takes place, you take the entry. Okay, again triple bottom, double top pattern, somewhat like a W and an M pattern. Wherever the wherever the breakout takes place, you take up the trade. Look at this and look at this. Wherever it takes place, you take up the trade. This head and shoulder pattern, this one. This is inverted head and shoulder pattern. It went down, came up, again went down a bit, forming the head pattern. Again, one shoulder was formed. The neckline of this was broken, and you take up a bullish trade. And this is the bearish wedge pattern, where the trade went down in the down direction. Here here the supports were multiple supports were broken, and the trade went down. And this one is the bullish wedge, in which the resistance were broken and the trade went up. Same thing, where wedge pattern, descending channel pattern, where they are forming higher highs and higher lows, basically lower highs and lower lows. The trade is going up, but in the meantime, in this part, flag patterns are also being formed. I'll just get to you how the flag pattern. This is some new concept. What does a flag pattern mean? It means that the trade went up here. It stayed in a downward channel this way, in one downward channel, and finally it broke out. It's gonna break out from here, and the trade goes up. So this is the straight the flag pattern that has formed, and it has given a bullish trade. All right, coming back to header, see, these patterns are very easy to identify. Once and more you see charts, 5 minutes, 15 minutes, 1 hour charts, patterns are formed, you take up the trade, simple as that. And after the patterns have been forming, after you take up the trade, go and to look out for the candlestick patterns for confirming it. All right, and you do the scalping. Head and shoulders pattern, coming back to head and shoulders pattern, look at this. Nifty went up, went down, a neckline was formed, 3 resistances were hit, and finally, once the neckline was broken, it went down. Inverse head and shoulder pattern. It means 3 bottoms were formed, 1 neckline was formed here, and you took up a trade, and the trade went up. So, look at this. This is a Nifty chart. This is 1860 that we got basically in the month of November. That was the top. It went up here, took support, again went up. Look at this, the candle that you see here. It's a bearish engulfing candle. It actually engulfed the previous candle, and it went down. All right, again it tried to retrace, and this is head and shoulder pattern. This is a screenshot I took and made some changes. So this, and after the neckline bottom, it was actually going down. Look at this, Nifty actually fell down. And this candle that you see here is a hammer. Okay, so basically it formed a hammer, and the trade entirely went up. Again, a bearish engulfing pattern that is formed here. You see this? Or you can also call it as a evening star pattern. 1, 2, 3, it engulfed, and entire Nifty chart went down. Again, look at this, almost like a bearish engulfing candle and our evening star candle, confirming the fact that it's going to go down. What do you mean by range bound market? It means that it moves in a certain range, it hits the resistances, and finally when the breakout happens, after hitting the 3 resistances, it makes the resistance weak, and finally the breakout takes place here. So this is called as a range bound market. Again, the same thing. Okay, let's talk about these charts. Trend identification, Fibonacci levels, and the support levels. Okay, what do you mean by support? Support is basically when the stocks take supports at the baseline levels. If the supports are broken, the stocks price will fall down. In case if it takes support and bounces back, it's going to go up. Look at this consolidation phase of the Nifty. It's the same chart. I'm showing it to you with the head and shoulder pattern. It's just that you see a lot many candles. It's a, I think, daily chart which I have constructed it, and you can see the patterns. It's moved. This market moved from March to May, July in the same range. It was a range bound market. Once the breakout took place, as I showed it to you on the previous slide, it went up again. It consolidated, it took support again, it went up, it hit a resistance here, came down again, it retraced back, and once this was hit, it was called as the resistance. Look at this, two resistances ideally, one here, again it formed a resistance, it came down here. Now what is this? This was something yesterday's 4 days chart from Monday to Friday, in which it is consolidating, it is taking support here. If any of the part, if this support of 16,200 almost, if it breaks down, the market is going to fall and it's going to go down. All right, so that's how we may take supports and resistance. Again the same chart, resistance, one resistance, two resistance. Look at this W pattern that is formed, 1 2. Here it might have been a neckline, and I must have taken a trade here somewhere here. All right, so this is a look at this another form. I showed you the head and shoulder pattern that was formed, right? 18, 16, 600. Look at, I can see another head and shoulder formation. Look at this, 1 2 and almost a 3. So here I have got the support. Okay, if now the market has fallen down and the neckline has been broken, and it is going to go down from here. See, you cannot predict, you can just predict. Okay, you can speculate, but you can't confirm. So basically, once the neckline was broken, the market might have gone down, and it has. This was the yesterday's red candle which I saw. Channel pattern, flag patterns. Look at this channel pattern. This is a channel pattern. The entire stock is moving in this channel pattern. This is a bank Nifty chart basically. So the stocks are moving in a channel pattern. Another part which was needed to be explained was the volume. Look at this volume. When the volumes are high, people trade, or most of the people trade on price action. This is something trade which I take. Like based upon the volumes, I take a bullish and the bearish trade. So these are the volumes. All right. Selling volume, when the red stick happens, the volume should be low, and I wouldn't have taken up a trade here because the volumes were still high. I would have taken this trade. Look at this evening star pattern that is formed. After this candle, I would have definitely taken a bearish this thing, and the market went down. Black pattern. Look at this. It moves in the channel. I explained it to you before, and the thing price goes up. Again the same thing, channel pattern. It moves, it takes support, multiple supports and multiple resistances have been formed. It is a range bound market, and wherever the breakout takes place, the market goes up and down. Moving average, I spoke to you about the moving average and MA crossovers. Look at this. This is the moving average I was talking about. Once the Nifty market, this is a daily Nifty market, it is a 200 moving average basically. No, it's not a 200. It's a 9-day moving average. Since I do the scalping, I require this 9-day average, and that's how the support has been formed. Once the moving average was broken, the market went down. Okay, so that's how it means. I wouldn't have taken up any trade here. Once I would have exited this after this candle formation, but this is how I take the trades. Once the moving average is cut in the bearish form, I take up the trades. MA crossovers. Look at this moving average crossovers which take place. Once the some of the trades are also been taken on the crossovers. This is the crossovers that I tend to tell you how the bearish people take trades. Once the bullish moving average crossovers the bearish one, the people take the trades. Now this is another 7-day crossover which I'm showing it to you along with the volume charts. These are the two confirmatory signs that I take. The one is the volume chart, one is the crossovers. Elliott wave theory. Elliott wave theory are about the patterns and impulses that are formed. Not much time to explain this, but this is somewhat the Elliott wave theory. First wave, second, third, fourth. But this is not the actual representation of the Elliott. The patterns are not rightly formed here, but it's all together a chapter in different ways. This is mostly used by the long-term traders or long-term investors. So basically, how the market is, they predict with this theory, is the market going to go up and down? Okay, so it's a complete chapter in itself, and it's really a nice one. So please have a note of it. Someone might explain it to you. Now these are just the how do you identify the trends. I've spoken everything. Reversal candles I spoke about. What are the reversal candles? From the where the market reverses. Look at this, one reversal candle, two reversal. It's a Nifty chart, huh? So daily chart. So I'm showing you the reversal candles here. Reversal, this again, the falling, rising wedge, falling wedge, ascending, descending triangles. It's the same thing. Look at this. Wedges formed and the market went down. Falling, this is a rising wedge, falling wedge, which is going down in pattern, and the breakout has taken place in this. Uh, Again, continuation and reversal forms. What are these reversal forms? Look at this. These are the continuation forms in which the market has gone up, took a support, again gone up, took up a support, again gone up, bounced back from this 50 days moving average, again went up, and this is a reversal pattern. Once the bearish engulfing pattern was formed, the market went down. Divergence. Now these are the technical indicators. I'm coming to the end of the topic, so I'll be showing you the technical indicators. What do you mean by RSI divergence? RSI is what? It shows the strength of the stock. It basically means that how much is the stock is in momentum. Look at this line that you see here. Let me just, okay, RSI. This is a RSI moving average. This divergence, look at this green line at the bottom. I put up an indicator on Kite platform where I put up RSI divergence. It shows me that green divergence, although the stock is falling here, it's coming down, down, down. Green divergence is coming, which means this green line indicates that the sellers are losing control of the stock. And this is just a warning sign that I shouldn't be staying in the bearish mode here, as you can see, because the stock might turn up the other way around, and this is the indication which shows that the stock is going to go up from here. Look at this line. Once the line has been formed here, I would have been very cautious, and the trade actually reversed. So this is something that I see for RSI divergence. There are two types of divergence. This is a positive divergence, basically in a falling market as the stock is coming down. The green line is formed at the bottom, and once it and I can see that yes, the sellers are losing control. I'll be cautious, and I would not go staying in the bearish mode for too long. So this is one of the indicator I meant to show, RSI divergence. RSI, what do you mean by RSI? 14 days RSI, it helps you to know how much is the stock moving up or down. What is the strength of the stock in the upward or downward direction. All right. So RSI is one of the indicator. Another part I use are the trend lines. Look at this beautiful trend line that can be seen. Once the trend line breaks from here, I'll be taking up the upward trend. These are the lower highs that are formed continuously in a chart pattern. So this is what it means. The trend lines are mostly used by the traders. Like I use the trend line most of the times on the 15-minute pattern or 1 hourly pattern. I do use the trend lines. How do you look at this? In this chart, I would have definitely used the trend line here, from here, starting from here till it has given up, from here till here, right? I would have joined the resistance point, and from here, once the breakout would have taken place, these are the lower highs that are formed in a continuous pattern, and once the breakout would have taken place from here, the market would definitely have jumped up. This is the stock indicator RSI. Can you see this? I think you can see this RSI indicator at the lower end here at the bottom. I put up an indicator. It tells me whether the stock is going to gain momentum. I will never trade the stock when it hits above 80 or above when it goes below 20. So basically, I'll always see to it when the RSI hits 20 part, I'll take up a positive trade. If the RSI goes above 80, it means in the oversold territory, and I'll take up a negative trade from here. So it basically indicates the movement of the stock. It may indicates how strong is the stock moving, how strongly the trend lines have been formed and moving. Bollinger Band. It is another thing which I learned in the early days. Like Bollinger's bands are also used to show the volume. You see here the upper and the lower band here, 20-day moving averages and all. Upper band, basically, the more the area that it covers, the more is the volume in a stock. Okay, as the stock moves to the lower end of the Bollinger Band in a flat market, I always take up a trade in a flat and in a channel type of market. Okay, when it doesn't move much, volatility is less, and in a range bound market, I use the Bollinger Band. So basically, lower band, it indicates that the stock has been oversold and it's going to jump back. Look at this. From here it has gone up. From here it has gone up. But this happens only in a range bound market. Okay, in a trending market, if even if it hits the upper band, it is going to go keep on going up till it stops. All right, I'll never take up a trade in this territory. Of course, I would have taken a trade seeing this engulfing candle, but had it been sideways here, like sideways somewhere like here in this part, I would have never taken a trade. So this is one of the indicator I use. MACD, mother or father of all indicators, as they say, because MACDs basically help you. Moving averages, crossovers, they show you. Look at this. The volume chart can be seen. Look at this. The black line indicates the buyers are in control. Red line indicates the sellers are in control. And corresponding, you can see it in the chart as well. The crossover has taken place. Here, the sellers have taken control. The red candle has been formed and the stock has gone down a bit. Now, MACD is basically also known as a lagging indicator, but because of the reason it gives signals at a much later part. Okay, they don't give quick signals, so I don't use this MACD indicator a lot, but it is really all the indicators of moving averages and all rely on this indicator to work with. Look at the crossover here. The crossover had taken place. Look at this here, and the red candle is someone form here, and the sellers took form. I could see the volume becoming red, and the candlestick pattern shows a bearish end trend. Support and resistance, again, this support and resistance, I've spoken about it. Pivot point is the ideal point where the stock has to be. Look at this stock. Look at this Nifty 50. In the end, it has formed a Morningstar pattern. From here, I would have taken up a trade to go up. And I use this indicator most of the time, stochastic, on 15-day on 15-minute chart. Stochastics also work this thing. When it goes below 20, it means it's oversold, and I will take up a trade once I find this Morningstar pattern. I would have taken up a trade here in this part. So conclude, what we studied was, first you identify the candles, identify the patterns of the trade, identify the trend in which the stock is moving, use the rationalized indicators, identify the breakouts, take up a trade, start with 1:1 risk reward ratio, and please always use a stop loss when you take up a trade. Your stop loss has to be there. Make it mandatory, make it a habit, make it a principle. So that's all I have today to talk about. So keep trading, keep investing, and have a wonderful, successful journey ahead. Thank you so much.
Thank you, Dr. Suyog. I just wanted to say a few things.
Yes, ma'am.
It was a very insightful session and very practical session. However, I wanted to know if there are certain websites that the students can, log in, maybe because tomorrow they are going to take a trade. So maybe in the chat box, if you can probably, you know,
Uh,
or I mean, because they will be taking the trade tomorrow, can you share, at least show a few websites which will be helpful for them?
See, websites, what I use. Can you see the screen, ma'am?
Yes.
Okay. Most commonly used website for me is this website called as a Trading View. All right.
Okay.
So this is the most common website that I use for Nifty trading. Just a
Yes.
minute.
And in that, if you can show how, you can set up all the things and accordingly, we will
Uh,
just take about, can we do that?
yeah, ma'am.
Especially a 1 minute or a 5 minute chart, so that students will be able to actually implement this for tomorrow.
Okay. Okay, can you see this, ma'am? The chart,
Yes, yes,
everything
yes, yes,
in my
yes,
screen?
yes, yes.
Okay. I think I'm just having some problem with this thing.
Okay, but trading view, if you can give, step by step, later on we can mail it to the students so that, they can may have a setup. So the next day, when they start trading, they will be able to observe the 1 minute and the 5 minute, candles.
See,
Yes, yes.
this
Yeah,
is the
just
trading view basically I
correct, correct.
used.
If
Okay.
you can just show now how we do the setup, we go in that. Take any particular script and if you can do it.
Uh,
Because for the beginners, this is very important.
since okay, fine. I take up any random script.
Yeah, that's okay. And this is the free version, right? Not the paid
Yeah,
version.
free version. In
Okay.
this script, no, in the basically in this free version script, actually what happens is that only three indicators you can use it.
I know, I know.
The paid
I know
version,
that's why I know that's why I'm asking. So students should know at least these two or three things that they can use, and
yes.
then accordingly take a position.
Okay, okay. Now look at this. I'm just using one of the script. It's of a cryptocurrency script. Okay. So
Okay.
most of the time I use this. Let's use this 5 minute chart. All
Yes.
right. Now
Yes.
it's very simple. Look at this. I'm seeing the resistance in this chart. I spoke about support and resistance, right?
Correct.
Here
Correct.
I can see three resistances that has been hit for 5 minute chart. It is
Correct.
here one part. Okay, I'll just draw
Yes.
the trend line.
Correct.
Okay, I'm just drawing a horizontal line here. Can you see
Yes.
this line?
Yes. Yes.
Now I'll wait, and I spoke about the chart patterns as well, right? So
Yes.
now I'm finding here three resistances. One here. Okay, one,
Correct.
two, and three.
Correct.
Right. So what I said, like if the resistances are hit twice or thrice, the resistances form, it becomes weak. All right. So what I'll be doing is waiting for this line to break out. If this line breaks out here, okay, so I'll be taking up a trade in this case.
Correct.
Okay. On
Right.
the another part, another thing. I see another pattern that has been formed. That is cup and handle pattern. Look at this. You see this one? That's a cup, and this is a
Correct.
handle.
Correct.
Again, confirmatory sign that I got here. That if
Correct.
this pattern breaks up, I'll take up a 5 minute trade. Okay. Now the indicators, what I'll be using.
Yes.
Uh, I spoke about the RSI indicator, RSI divergence.
Yes.
I'm putting up a RSI divergence here. Okay. No, I don't see any divergence here, basically. Okay. So basically, I would have taken up a trade. If this thing breaks, I'll take up a trade. I do not see any divergence. Why I do not see any divergence? Look at this. The top of the RSI indicator and top. Here the prices have stayed the same.
Correct.
Had these top formations have gone down and the prices would have been going up, I would have seen that, you know what, I'm looking at the negative divergence here, and the trade might fall down. So unless and until this candle stays above this line, resistance line, at least for 5 minutes, then I'll do a bit of scalping here,
Correct.
or else I won't. Now I have taught things about the basic. Basically, now I'll show you some of the chart patterns on this if I can see. Okay, uh, look at this. The supports that have been formed here. It's a 5 minute chart. It took up multiple supports here, right?
Correct.
One, two, and it has stayed here for a longer time, which means that the price was not ready to go down. I would have definitely taken up a trade. Look at this pattern formation that is formed here. It's a
Right.
Morningstar pattern, right? Now, why do I ask to take up a stop losses every time? Because after this candle, you see these three candles, I would have expected the trade to rise for 5 minutes. But had it consolidated here, it rose later on. But I wouldn't have stayed in this trade for long because my trade is based upon 1:1 risk. I do trading on 5 minute scale, so I really won't extend my time process because my entire strategy goes wrong. All right. Now,
Right.
this let's see something on 15 minutes pattern. Okay, again the 15 minutes pattern. Look at this. It has taken multiple supports here almost, and it is forming a type of constricting triangle here. Look at this. You see this?
Yes.
One support line on 15 minutes, nothing more. So once if this support from here, if it's broken, it goes up from here, I would have definitely taken up a trade here because it has given a breakout on 15 minutes, and my trade would have been just for 15 minutes itself. This green candle, I would have cut down my position here once it breaks. So this is a constricting triangle that you can see here. Uh, I basically want you to I want to see another type of pattern is the W shaped of pattern if it is formed somewhere here. I don't know if it is formed, but a Nifty chart you can we will be able to see. No, nothing of that sort.
Yeah. Yes. So, Dr. Suyog, I think
Yes.
most of the students have got it that first they have to just log in and
Yeah.
accordingly check on the 5 minutes and the 15 minute and check out, the patterns that are and
Right.
trends. Yes. There are two or three questions if, time permits. Can I ask you?
Yes, please.
So one of the first question that Shubham is asking is there is a saying trend is your friend. So, do
Yes.
you believe that one has to ride the trend until it reverses? Can you kindly
Absolutely.
elaborate on this?
Absolutely. You should write the trend. Because but at the same time you need to trail your stop losses. For example, if we see the Nifty chart, okay, it really showed a good breakout. All right, so you have to write. You cannot beat the markets. You cannot decide what trend I'll follow today. You have to move according to the trend because it's very simple. I mean, there's you are the market is supreme. Everyone says that. Look at this trend. Once the market reversed, you have to follow this trend. Till here, I would have drawn a trend line from this point till here, and once the red candle occurred, a confirmatory red candle, I would have broken my position here. You understand? So trend, what's the point of moving against the trend? If you want to earn money, you have to move with the market, or else it's gonna eat up your capital. And I might say I decide trade on 1:1 risk ratio, 2:2 risk, 1:2 risk ratio, but I can see profits going on. I can see the charting pattern. I can see things are progressing in the right direction. Why would I want to go against the trend? I wouldn't, right?
Right, true.
Yeah, so drawing trend lines are really important. They are the easiest way to ride, and the trend lines basically, I personally feel that even the moving averages no act as a trend lines for us.
Right.
Okay.
There are last two questions which I wish to ask you. Snehal, one of the participant, is asking. There are wide variety of tools which give a confirmation to take a trade.
Hmm.
So, can you kindly share the tools that you normally use?
Okay, I'll just share it with you. Are you the one that we use are the RSI,
Yes.
Relative Strength Index? Yeah,
Okay.
and another that I personally use is the stochastic RSI. It's a combination of the tools that I use basically. This is the okay. I'll just take this out. Stochastic RSI. These are the two tools that I use in combination. Basically, when I want to do scalping, I put up a chart. I draw my support levels. Look at this. Nifty on a 5-minute chart.
Correct.
Okay. So in this, when it goes below 25, it's when it's in the oversold territory. If I find a pattern forming here, so I will always take up this trade. Like it's in the oversold zone. I'm getting the pattern formation here. I'm seeing supports are here at 16,200 part. Okay, it has taken support and it has bounced, so I'll definitely take up a trade here. On the other hand, if I'm finding resistance at this part 16,763, I'm showing it. I'm seeing it in an oversold territory here. I'll always go in for a bearish trade because it is showing in the oversold territory. I'm seeing the crossover here of the selling people are more than the buying people here.
Right.
Okay, the crossover already has happened. One red candle ideally has been formed. It took up a rejection here. Of course, it's the opening of the day candle I'm showing you, so I wouldn't have taken a trade. But however, once I see the rejection pattern forming and lower lows forming pattern, lower highs have been forming, so I'll definitely take up the trade. 3, 4 things I'll go on to see before taking up the scalping part.
Okay, thank you so much. And then the last question, Prathamesh. He is asking, when we consider the recent geopolitical tension in Ukraine, normally the study suggests that Nifty 50 usually corrects by 31 to 37% on an average in
Right,
any market. And the
right.
recovery post bottom formation takes about 6 months to a year. So, do you believe that from this, levels uh, of today, do you believe it will cross 18,600 by Diwali 2022 or somewhat 2079? That is the coming Diwali. So, what is your take on this, Dr.
See,
Suyo?
if we go on to see the empirical data and the wars that we face now, there is
Yes,
only one time that our Nifty took time to bounce back. That was from the 9/11 attack. Okay. Second and the most important thing, I'll see Nifty has retraced to about 12 to 13%, and the
correct,
banking stocks have gone down till 30%, like HDFC and all. So
correct,
I will basically, yes, obviously, ours is a progressive and an emerging country. It is going to go up, but you or me or no one can tell when it can go up. Okay, still Diwali or anything, it might bounce back in 4 months, 6 months as well if the war tensions end. But rather than following all these things now, I prefer that you keep on learning and looking at the charts and start taking up a trade. Of course, these are the news-based things. So, anyways, it will be getting reflected onto the charts. We should follow the support lines we should draw, the resistance line we should draw, and start taking up the Nifty thing. Yes, it is in the fallen zone, but Nifty has just retraced 10 to 13% from 800 levels. Not even it has fallen below 20%, which means we are still not in the bear zone territory. Look at after the COVID crash, 7,500 we reached down to the bottom, and Nifty shoot up till 16,800.
correct,
8,000 points, 10,000 points, it's not a small number to go in 2,000. Insanely it ran up. Somewhere
correct,
Nifty had to cool off, and we just found a reason now because of the FedEx meetings that are coming up, because of the
correct.
war that is happening. So Nifty is just cooling off. But surely we should start investing, and yes, Nifty is going to go up and
Right.
go till 20,000. I hope it goes till Diwali.
Okay. Okay. Thank you so much, Dr. Suyo, for taking your time out and encouraging our young millennials to do day trading. Thank you so much.
Thank you so much. It has been a pleasure. Thank you.